The Federal Reserve holding interest rates steady after this week's policy meeting as officials signaled just one rate cut this year. My guest has advice for investors on how you can take advantage of the higher for longer scenario. Joining me now is BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. Rick, thanks so much for coming by the studio.
Thanks for having me. Appreciate it.
So, there's been a lot of discussion about how much longer the Fed has to keep rates where they are to tamp down inflation. But you're making the case that these higher rates may actually be sparking inflation more than keeping it down.
So, I would say it's ambiguous as to what the effect is, but it's definitely not helping to actually keep it this high. There's a couple of things that are historic. You had this massive transfer of money from the government to the private sector. It's actually made the private sector a net creditor, a net lender in aggregate. Pretty extraordinary. Think about what higher rates for if you're a net lender. That's pretty spectacular in terms of the benefit. And then, by the way, those people spend, it gets into services. That's why service level inflation, part of why service level inflation is high. Second thing that's amazing is the aging of the population, which has been historic. Older people tend to be net savers, interest rate benefits, and it's pretty incredible when you look at things like healthcare insurance, et cetera. So it's not having that significant impact. If you drop rates 100 basis points, you're not going to see any tangible acceleration of inflation, and it's going to help small business, lower income that's hurting from this.
You had an incredible statistic about all the new income people have from higher rates just from savings accounts. I think $1.2 trillion in new income just from higher savings rates.
So you think about how incredible that is. And so, by the way, when you aggregate the economy and say the economy is in good shape, and it is, but what's happened is there's a stratification now. There's a two-speed economy driven by that immense amount of income going to higher income, generally older parts of the population that have already paid down their debt. And so what's happening is keeping the economy in good shape, it's keeping growth in pretty good shape, but there's a balance. And this balance of can you equilibrate the economy more effectively? And I think you can. And certainly don't think it'll have an adverse impact on inflation.
I'd like to hear what you think the path of interest rates is. And you have two charts that are kind of interesting showing the dichotomy between goods, which have come way down. In fact, I think it was below, it's actually disinflation. And then services, obviously, as you said, are up. But what was amazing to me was the vacation prediction. That's unlike anything we've ever seen.
So I'd say first thing is on this chart. So now if you look at year on year, core goods is negative. Pretty extraordinary. Think about where we were. We were running at double-digit post-COVID. By the way, the thing that interest rates are most sensitive to is goods. That's what's more sensitive. Service inflation is still sticky high. Why is it? This shift that I talked about to services, but also it's a cultural change. People are spending more on experiences, restaurants, hotels, airlines. You look at this, people planning a vacation. There was a surge after COVID. I'm locked in my house. I need to go on a trip. But it's a persistence to it that is real. And I think that's structural. I think it's cultural. And it's a good economy. And it's a good economy with a cohort of people that has money to spend.
Okay, let's talk about the investing playbook here. You're a fixed income guy mostly, but you manage some equities. Tell us where you see that market.
Listen, it's pretty incredible. If you go back in time and think about for years, we were working on 0% interest rates, 1% interest rates. Now you can build a portfolio. The risk-free rate in the front end of the curve is 5 3/8. You can build a portfolio 6.5 to 7. You don't have to go out the yield curve. You don't have to take a lot of risk. You can stay in high-quality assets, AAA CLOs, agency mortgages, investment-grade credit. Build 6.5 to 7. Use a little bit of high yield. High yield market's in way better shape structurally than ever before.
You've got a new ETF, BINC, that's doing well.
Yeah, so we're a 7% yield horizon rate of return over your holding period. And if you think about what that means, it's the average rating is high BBB. It's 60% the volatility of the high yield market. Better, higher quality, more diversified. We use securitized assets, investment grade. We use parts of Europe where growth is slowing. You want to be a lender.
Because those rates will come down, you think?
Those rates will come down. They'll come down faster. And you can buy investment grade companies as a dollar investor, get 5.5 to 6%. By the way, we used to lend companies in Europe at negative rates. Remember negative interest rates? The craziest strategy ever. But now, so you can build income and you can own your equities. And I think the equity market's in good shape. So you can create a nice balanced portfolio, income and equity. That's different than 10 years ago where you had to own way more equities because you couldn't get the income otherwise.
All righty. Rick Rieder, thanks so much for coming by. Good luck to the Orioles this weekend.
Thank you very much. I'm pulling. Thank you very much.